Good afternoon, everybody. Happy Friday. Very busy week this week. I was down in Sydney at the start of the week attending some investor meetings and now back up in Gloucester to close out the week. Let's hop straight into the 5 largest developments for the week. Number 1, RBA held the cash rate steady at 4.1%. This is the 3rd consecutive interest rate hold. Inflation has eased down to 4.9% annualized after hitting a peak in December of 8.4%. We've also had the fortunate thing where the labour market has started to cool as well. The RBA essentially is betting on the trend that the labour market is continuing to cool, as well as inflation easing. That's going to continue for the foreseeable future. Interest rate markets are expecting further rate holds up until the end of the year. Australia's GDP grew 0.4% for the second quarter. This is after showing a first quarter growth of around about 0.4%. Again, we've seen very strong second quarter growth coming from Australian exports, and this made annualized growth of around about 2.1% for the sector. Third thing, Bank of Canada left interest rates steady at 5%. Markets were expecting interest rates to be held at 5%. However, we have seen a sharp contraction in the GDP for the second quarter and also a combination of weak consumer demand. This has meant that interest rates are held in Canada at 22-year highs. One of the contradictory things was the Bank of Canada governor continued to voice concerns that there was elevated levels of inflation, and this admission left the markets under the impression that there may be further rate hikes coming up over the next 6 months. But at this stage, with the fundamental declines in GDP and also consumer demand, it seems like that is somewhat unlikely. The fourth point, US ISM services PMI surged to 54.5, showing further growth and expansion. A reading sub 50 is contractionary, above 50 is expansionary, and this has been the 8th consecutive month of expansion. So this provides a lot of hope that there is going to be a soft landing for the US economy. Last point, US unemployment claims fell to 216,000. Expectations were a little bit higher with an increase of 232,000, but once again by a very strong employment market and labour market in the US, it does provide hopes that there is going to be a somewhat soft landing for the US economy. The inverse of this is that it somewhat worries markets to a degree that there could be, if the labour market continues to strengthen, that there could be a period where interest rates need to go further or at least higher for longer. Outside of that, we move across into a summary of the futures market. Again, a lot of these strategies or a lot of these futures markets are held within our multi-strategy hedge fund, which trades fixed income, currency, commodity, as well as equity markets. Biggest performer over the course of the week has been sugar. That has been on quite an impressive rally as of late, similar with cocoa. Worst performers of the week, you've seen natural gas has underperformed coming out of or after the summer season. People are repositioning based on how cold they expect the North American winter to be. We've also seen one of the best performing parts of the futures markets that we look at being the VIX. Again, this sort of flows through to what we saw earlier with very strong data coming out of the US economy. Strong data essentially means that there is some type of likelihood that interest rates could increase further, which means equities have sold off. The worst performer for the week in the equity markets has been the Russell 2000, the small and mid-cap part of the market. There has been a lot of volatility over the last couple of days for commodity markets. You've seen canola, coffee, cotton, and rough rice have all been a little bit volatile, and a lot of this is because of Category 4 Hurricane Lee, which is currently moving across the Caribbean, and people just naturally feel that there is some risk in the market because this could impact crops. We've seen this on the other side as well with oats and corn as well, and wheat on the long side. The Australian share market over the last 3 to 4 days has been again selling off. This has been somewhat of a similar theme over the last, well, probably over the last 3 to 4 months, 5 months, where the Australian share market has rallied about 5%, then sold off 5%, rallied 5, sold off 5, and it really has not been going anywhere. Over the course of the week, the big banks, CBA, NAB, ANZ, and especially Westpac were dragging on the market. Macquarie came out with their full year report and it missed market expectations marginally, so they have underperformed over the course of the week. Rio was in the green. Mineral Resources, after announcing a further acquisition, has bounced to a degree as well. BHP and Fortescue were the worst performers, but Fortescue at the moment is really out of favour just generally in the market. If you've been reading the AFR, you've heard about management changes, changes in their expectations for demand coming out of China, as well as just generally the investor mood for Fortescue or towards Fortescue is a little bit sour at the moment. ResMed, CSL have continued to underperform. The only real consistent bright spot for the week has been Woodside and also Santos, and this flows through to what we're seeing here with some of these energy markets being relatively okay for the week. Outside of that, we can see the trend barometer. We are starting to see a little bit of a pickup just recently, but these markets have been very, very volatile as of late. Short-term and long-term trends have not been consistent like we saw through the period of July, which just generally demonstrates that commodity markets are teetering either at short or long-term highs and either about to break out or revert. We are seeing a lot of these constituents within our futures fund universe are all very close to these levels, but as of yet, they just really have not continued and established and started new trends. Outside of that, there's lots going on in the markets at the moment. If you have any questions with regard to the breakaway momentum indicator that we have sent through to our investors over the last week, please reach out. Some very interesting takeaways there for this next 3 to 4 months, which seasonally is very strong for the time of the year for equity market returns. Other than that, have a nice weekend and we'll speak again next week. Speak to you then.